Hey everybody, welcome back to another edition of 5 Question Friday. This is where I do my best to answer questions that you all have sent in. If you want to submit a question, the easiest way to do it is to subscribe to the newsletter with the link below this video. It's free, it goes out every Sunday morning, and you can just hit reply, send me your question. I do read every email. I reply to a lot of them. I try, but I read all of them, and that's where I get the questions from for this 5 Question Friday. So let's dive right in. The first question of 5, why is Bill Bengen, who's the father of the 4% rule, why does he now say it's actually the 5% rule? That'll be question 1 we look at. Question 2 today is if we're going to build a Social Security bridge, that is between the time we retire and the time we start claiming Social Security, is it okay to put all that money in a money market fund? Another viewer, Steve, wants to know whether Fidelity's zero funds that don't charge an expense ratio, how do they compare to Vanguard index funds? Number 4, how should we think about cash that we're going to spend over the next year, let's say, as part of our asset allocation? Should it be part of our asset allocation? And how much cash should we take out? And then finally, a viewer has a question about converting Vanguard mutual funds to ETFs, and we'll take a look at that. So let's dive in. So Bill Bengen is he's coming out with a new book. I think it's August 5th when it comes out. I'm looking forward to reading it. And he's been on the sort of the interview circuit, I think, in part in prep for that book to come out. And he said, look, hey, it was 4%, but now I really think it's closer to 5%. And the question is why? What's changed? And this was the question Aaron had. And the short answer is absolutely nothing has changed. The thing to keep in mind is there is no one safe withdrawal rate. Even if we're talking about it in the context of adjusting your annual spending each year in retirement by inflation, even if we make that assumption, which is one of the assumptions Bill Bengen made in his 1994 paper that gave us the 4% rule, there still isn't just one safe withdrawal rate. Why? Well, I made a list of just some of the factors here that affect the safe withdrawal rate. Length of retirement. He assumed 30 years, but you could assume something else. Asset allocation. So there's 2 things here. He concluded you needed between 50 and 75% in stock. So that's one assumption. You're going to have a portfolio somewhere in the 50 to 75% equities range. In his paper, he assumed all of that would be in the equivalent of an S&P 500. But you could assume something else. You could assume you'll have international as well, and you'll have maybe you'll overexpose to REITs or small cap value. The different ways we could construct a portfolio are pretty much limitless. So each change we make could change the safe withdrawal rate, and we'll come back to that in just a minute. He assumed no investment fees. So that's a big assumption, particularly if you're paying an advisor 1% or more. He assumed you rebalance once a year. That's another big assumption. There are some strategies where you don't, like the bucket strategy. With the bucket strategy, depending on how you implement it and what's going on in the market, your asset allocation can change every single year. So that's another big assumption that he made. Again, I think all reasonable assumptions that he made, but that doesn't necessarily mean that's what you're doing, right? Another big one, annual spending adjustments. He assumed you'll increase your spending by the rate of inflation as measured by the Consumer Price Index. We know, studies tell us that that's not how retirees actually spend. We tend to spend less money as we age on an after-inflation basis, and that's even factoring in the increase in healthcare costs that many experience later in life. And then the last one I'll mention, there are others really, but these are sort of the key ones in my mind. What chance of success are you demanding? In his paper, he said, I want a 100% chance of success as measured by the historical record, as measured by the history of the S&P 500 index, as measured by he used intermediate treasury bonds for the fixed income, as measured by that record, and as measured by the CPI. He went back to 1926. Others, believe it or not, have gone back to 1871. If you're wondering why those dates, it's just because that's where some data is available. Those weren't arbitrary dates, but the point is, for a very long time, this has worked out. Doesn't mean it'll work out in the future. I think what he's done more recently is change the asset allocation. He said, hey, why don't we add some international, maybe some small cap, maybe some gold, maybe some REITs. And so from that, he's sort of bumped up the what he calls the safe withdrawal rate. And for a long time, it was around 4.7, but maybe he's getting a little closer to 5%. Honestly, I take a little less comfort in doing that. I certainly have a more diversified portfolio than just the S&P 500 index, and I would not be comfortable in just the S&P 500 index. But when you're starting to use very specific asset classes like small cap and gold, we can certainly look back in time and say, okay, maybe things worked out. I get a little nervous saying that they're going to necessarily work out just as well in the future. But frankly, I think these last two, annual spending adjustments, because I just don't think that's how we live. I think a lot of people, for example, cut back spending when the market drops a lot. And most people, or a lot of people, have the flexibility to do that. And I don't think we necessarily demand a 100% chance of success as measured by the historical record. Those, to me, are sort of elements that we can adjust to maybe increase the safe withdrawal rate a bit. And I think 5% could even be very reasonable. But I think, and we'll see what he says when his book comes out, a lot of this is coming out of changes in his thinking on asset allocation. Again, also, I think, very reasonable. And so that's how he gets to the 5% rule, I guess, if we're calling it that now. It's just the thing I want to stress is nothing's changed. I mean, we have a little more data since 1994, of course. And so far, it continues to support, I'll say, the historical 4% rule, using all of the assumptions he used in his 94 paper. That's probably going to change at some point. The real question isn't, does it change a little? I don't think we're going to lose any sleep if the 4% rule becomes the 3.9% rule, although I'm sure it'll be big news and everyone will be talking about it, maybe me included. I think what we really don't want to see is really, really big changes in the safe withdrawal rate, which could happen, but at least, again, if history is an indication, would require some pretty significant things, even beyond like our deficit and debt, arguably. The countries that have suffered and have really, really low safe withdrawal rates, think 1%, are countries that had hyperinflation, think Germany after World War I, or that were just devastated by World War II, think Japan, European countries, where not only did they lose the war, but their countries were devastated because of the war. Those are the kinds of things that generate a really low safe withdrawal rate. Again, what the future holds, well, your guess is as good as mine. But that's my take on Bill Bengen's current thinking. Again, we'll get his book. We'll see what he has to say. All right, this one comes from Tom. His question is this. He wants about a 10-year Social Security bridge. So he's going to retire and then wait 10 years to claim Social Security. That's a pretty long bridge to build. And his question is, should we put it, is it okay to put it in VMFXX? That's a Vanguard money market fund that's currently earning 3.5% dividends. My take on this is, I think that could be okay. Certainly it's quote unquote safe in the sense that you shouldn't lose any money, right? It may not be safe though when compared to inflation. And the issue is, right now he says it's paying 3.5%. I think that's about right. I haven't checked it, but depending on how you measure inflation, that's at inflation or maybe a little bit better than inflation on at least before taxes. And so that's okay. But money market funds don't always pay out yields that exceed inflation. And 10 years is a long time. I think if I were doing it, what I would probably do instead, it's a little more work, is I would build a TIPS ladder. I would build a TIPS ladder for 10 years so that between the interest payments I would receive each year plus having some number of TIPS bonds maturing each year, I'd get that money as well. That would give me enough money to bridge the time between retirement and Social Security, and I'd be protected against the possibility of higher than expected inflation. A great tool, and I'll show it to you, we've talked about this in the past, that you can use to build the TIPS ladder is tipsladder.com. And you can go through and generate ladders. They have different tools that you can try. And it takes a little bit of time just to figure the tool out. I've talked about it in the past. Maybe I'll do a separate video just on the tool. But I think it's a really good way to build a TIPS ladder. It's very easy. And one of the things it will do is actually tell you using the QSIP numbers, which are unique identifiers that identify specific TIPS bonds, which tips you should buy given how much money you need each year from this tips ladder. And you could actually go into your favorite broker and use that CUSIP number to identify the bonds and buy them. So it's not that complicated. Like I said, I'll do a separate video on the tips ladder tool, but I've talked about it in the past. That's probably what I would do. If I needed a ladder for 1 or 2 years, just for convenience, I'd probably throw it in a money market or maybe an ETF like VBIL, VBIL, which is a Vanguard short-term treasury ETF, because I'm not as concerned about inflation. I mean, you're always concerned about it, but over a short period of time, I might be willing to take the risk in exchange for the convenience. But 10 years for me is a long time. I'd probably go with the tips ladder if I were in that situation. All right, question 3. How do Fidelity's zero funds compare to Vanguard index funds? I actually did a video on this a couple of years ago, and the zero funds were fairly new. I don't own the zero funds. I'm probably for reasons that aren't necessarily all that logical. I'm just more comfortable with Vanguard index funds. But I think the zero funds do well. The thing to know is that they don't track the same indexes that Vanguard funds do. So like the Vanguard S&P 500 index fund, which is right here, this tracks the actual S&P 500 index. And Vanguard actually pays a fee to S&P to do that, to track that. So one of the ways Fidelity, and here's their comparable, this is the total market. We'll look at the comparison in a minute. This is the total market, which would compare to like Vanguard's VTI. They don't pay S&P or other index fund providers. They've created their own. But they've created it in a way that they think it will pretty much match the better known indexes. And so we have a fair amount of data now. If we go to the chart for this fund, again, this is the total market, and we max this out, it goes back to 2018, so that's a pretty good time period. And we can compare it, this would compare to VTI. We want to get the data type right. NAV growth, but we'll just do growth with dividend. I don't know if this changes much. But you can see they're neck and neck. In fact, actually, the Fidelity fund has outperformed a bit. So there you go. But they're pretty much neck and neck. I would be very comfortable with the Fidelity zero funds. I wouldn't expect to outperform with them, though. If you look at VTI, it's like 3 basis points, I think. I mean, it's so inexpensive. I suppose one could say, well, it may be a little, 3 basis points. It may not be a big difference, but if, why not save the 3 basis points? It would be a question of how comfortable you are using Fidelity's own sort of constructed index. But, we've got 7 years of data, and so far I think it's done really well. So there you go. Great question. Should probably update that video I did a few years ago. There are really, I think, 2 questions here from Janet. And they are, if I understand her email, one is, how much cash should we have on hand as we're spending during retirement? How much should we pull out? And how do we think about that cash when we're doing our asset allocation, when we're constructing our portfolio and coming up with the percentages? And that's a great question, a very practical question. I can tell you that, if we think about Bill Bengen and his 94 research paper, he just took a whole year's worth of cash out. And I don't believe included it, although I don't know that his paper explicitly says this. I don't believe he included it in the asset allocation. I think he took out the cash and then rebalanced, in that case, between stocks, S&P 500, and intermediate term treasury bonds, rebalanced what was left. And then, again, he's just modeling this for his paper, but this hypothetical retiree would then spend down that 1 year's worth of cash and then do it all over again. I generally think that money that I have set aside that I'm spending over the next 12 months, I do not include in my asset allocation. That's just my approach. I think it's easy to implement. I don't think there's a right or wrong here, but if you include it, then each month as you spend it, your asset allocation is changing. Of course, you could say, well, that's no big deal. It's changing anyway as the markets go up and down, and I'll let it change, and maybe you rebalance once a year. I doubt it would change how you think about your portfolio, but I tend to pull the money out. in my case, I don't normally do it a year at a time. I usually think about it a quarter at a time because it just seems to work for us, particularly since that's how dividends are generally paid, quarterly. And so I do it a quarter at a time. Plus, it leaves more of my money invested, which I prefer. But again, I don't think taking your money out a year at a time is some big mistake that's probably going to, I doubt it's going to make any significant changes to your outcomes over long periods of time. I'm just more comfortable doing it one quarter at a time. And yeah, I don't include it in the asset allocation. And that's just my approach. You could include it in your asset allocation. I think one question to think about is if you did or didn't, how is it going to change what you do? And so at the end of the year, if you rebalance once a year, I suppose you've got 3 or even 12 months of cash. You could include that in your fixed income. And I suppose the result of doing that is you wouldn't have in what's left even more bonds because you'd have a year's worth of spending that would account for part of your fixed income. But again, presumably that's going to be a relatively small amount of money, 3 or 4%, let's say, maybe 5%. So I don't know at the end of the day, it makes a huge difference, but that's my approach. I take out and think about my cash needs on a quarterly basis. And when I pull that money out, I put it effectively in a checking account. But I use one at Fidelity called a cash management account that lets me invest in things inside that cash management account. Once I put it there, I exclude it from my asset allocation. That's just been my approach. All right. Getting to our last question. Should we convert Vanguard mutual funds to ETFs? And Corey says, I'm considering this conversion because I've heard that ETFs are more tax efficient than the mutual funds and they have modestly lower expense ratios. So I generally think, and I've converted mutual funds to ETFs, and I've also chosen not to at times. I really don't think with Vanguard funds, the lower expense ratio or the tax efficiency, I don't find either reason particularly compelling reason to convert to mutual funds or ETFs. It's certainly, I don't think, a mistake. I just don't find it compelling. Why? Well, let's see here. We'll look at 2 funds. We'll compare the Vanguard S&P 500 index, this is the mutual fund version, with the ETF version. So it is true that the ETFs tend to be a tad cheaper, but again, we're talking Vanguard index fund, so it's very small. This one's 3 basis points. So 100 basis points is 1%. So this is only 3 basis points. It's just a fraction of 1%. Mutual fund, 4%. So again, I suppose you could say, well, okay, yeah, 1 basis point is probably not going to make a big difference. But, if I'm going to choose, why would I pick the more expensive one? Well, the thing to keep in mind is that when you buy and sell ETFs, you're also paying a spread, a bid-ask spread. Now, at the moment when we're looking at this, the market has not opened. I'm recording this at 8 a.m. So that spread, I'm going to guess, is going to tighten a bit. Right now it's 5 pennies. It just changed. Now it's 3. No, it's a lot now. No, it's not. It's 7, I guess. But I generally don't buy and sell ETFs. I don't do it after hours, and I let the market open and at least for a half hour. And so this spread could come back to just a penny. But there is the bid-ask spread that you'll end up paying. And so at the end of the day, I kind of view the fees, particularly, again, we're talking about Vanguard funds, as kind of a wash. And then if you look at how they distribute income, Vanguard mutual funds are incredibly tax efficient. And actually, the ETFs are really just a different share class of the mutual fund. It's kind of interesting how they constructed this. They actually got a patent on what they did. I think the patent has expired now. But in any event, if we look at performance, we can look at distributions. And one of the things I look for is I don't want to see any blue in here. Blue are short-term and long-term capital gains. We know that if we choose to sell a mutual fund or ETF at a gain, we've made money and we choose to sell in a taxable account, that's going to trigger either short or long-term capital gains. That's fine. We know that and we can control that. But what shows up here are short or long-term capital gains that the mutual fund itself distributes even if you don't sell anything. We don't want to see that. Green is okay. Green is the income. So that would be dividends in a stock fund interest in a bond fund. This is a stock fund, so these are all dividends. We would expect dividends, because the S&P 500 pays dividends. Not a lot, about 1.3 maybe. Let's see. Where's the dividend yield? They change this every now and again. It kind of drives me crazy. Here we go. Yeah, just under 1.3. But what we don't want to see is blue, and we don't see blue for this is the ETF. So what about the mutual fund version? Go to performance, distributions. There's no blue. Yeah, they don't distribute short-term, long-term capital gains. We could, by the way, also go to the chart here, and we can max it out. We'll set this to growth with dividend, and we can compare it to VTI. And a viewer showed me something you can do. You notice that the red line stops in 2001. It's not the same amount of data, but we can actually have a start date as common. Let's see if it works. It does, thanks to the viewer who brought that to my attention. So this is, see, VTI is actually outperformed. That's kind of interesting. I actually didn't look this up before the video. This could argue in favor of oh, wait a minute. Nope, never mind. Wrong fund. I was comparing the wrong fund. Okay, now we're looking at it. Now this makes better sense. That kind of shocked me. I was comparing the total stock market fund with the S&P 500. Now we're comparing the VFIAX, which is the Vanguard S&P 500 mutual fund, with VOO, which is the Vanguard S&P 500 ETF, and they're neck and neck. The ETF, actually in this case, the mutual fund outperformed, but I mean, it's negligible, and you can't even tell there are two lines there when you look at the chart. So yeah, at the end of the day, and this performance, by the way, would be after the expense ratio. Yeah, it doesn't really matter. I think the one reason you might consider switching from a mutual fund to an ETF, and you want to make sure you can do it without triggering taxes. At Vanguard, you can for some of their mutual funds. But if you were thinking of moving your funds out of Vanguard to another broker and you wanted to continue buying them, if you move out ETFs, you can buy them at wherever, Schwab or Fidelity, without paying any fees other than the bid-ask spread. If you move mutual funds over and you want to buy shares of mutual funds of Vanguard funds, you end up paying a fee, I'd say $75 to $100 per purchase. So to me, that's probably the most compelling reason to convert Vanguard mutual funds to ETFs. But if you're going to do it, you have to do it while it's at Vanguard. You can't move the mutual fund over to, say, Fidelity and then convert it to an ETF. You can't do that, at least to my knowledge. I think you've got to be at Vanguard to do that. So there you go. Great questions as always. Hopefully I've done an okay job answering them. Looking at that chart where I had the wrong fund up there kind of jarred me. It'll take me a couple hours to recover from that. Anyway, hope you have a great weekend. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.